S&P 500 is down 15% high to low, almost 12% for the year. I'm sure you're all noticing your 401ks go down in value and worried and thinking about what it means to you, what it means for the future, what it means for your job, employment. Welcome to Finance Tech. I'm Shalabh Garg, 25-year veteran of Wall Street. I've had jobs at banks, I've had a job at a hedge fund, and I currently run my own hedge fund. Today we will talk about tariffs, what they mean, how they've impacted your 401k, what to do next, how to keep your job, and how to prosper into the rest of the year. Let's take a minute to talk about tariffs and what they mean. I'm sure you've heard all kinds of stories around Donald Trump, the president, putting reciprocal tariffs, putting 10%, 15%, 50%, all kinds of tariffs in all kinds of countries. In a basic nutshell, the president wants us to go back to the barter system, where China gives us jeans and we give them soybeans in return. So no currencies in between, and who determines the value of how many jeans are equal to how many soybeans? We don't know. And what that means is that all of a sudden, the supply chain that existed for 50, 100, 150 years between jeans from China and soybeans from America is broken down. In even simpler terms, think of an island which had bridges and tunnels going to all over the cities around it. And all of a sudden, all those islands are broken. All those bridges are broken. And if those bridges are all broken, obviously the price of bread on the island is going to go up, because the bread that was being delivered through those bridges cannot be delivered. Why is that important? Because this is not the same kind of inflation that existed leading up to this year. The inflation that existed over the last few years had to do with demand. People were prospering, people's wages were going up, people were consuming more, and that resulted in prices of things going up. That's good kind of inflation, one that can be combated by Federal Reserve, by raising interest rates and other factors. This is bad kind of inflation, which is a one-off supply shock. I would not focus on inflation, I would focus on its impact on growth and on demand, which is getting negatively impacted. And that's the reason why the S&P 500 is down 15% and probably will go down a little more. What should you be doing and how should you be planning into the future? Okay, let's start with what you should not be doing. Number one, do not panic. S&P 500 goes down 15 to 20% all the time. This is not the first time, this will not be the last time. It is important to stay with plan. And what is plan? To keep investing in average costing down month after month, every month. Now, I'm not a single stock trader. I'm not going to recommend Nvidia and Tesla and all these other single norm stocks. But as far as your personal portfolio is concerned, this is a really good opportunity to sell some of your fixed income portion of your portfolio and reinvest it into S&P 500, or reducing cash and reinvesting it back in S&P 500. Remember a simple rule of thumb: down 10% on S&P, you buy; down 20% on S&P, you buy a lot; down 40% in S&P, you mortgage your house and buy. But remember, in the last 100 years, there's 2 or 3 opportunities where S&P is down 40%. So it's not very common for the S&P 500 to be down 40%. So that's my first piece of advice. Now, that's as far as financial assets is concerned. What does it mean for you, for your employment? Because S&P 500 corrects much in advance of the recession. So even as a recession may be unfolding, S&P 500 could easily be rallying, while it may feel like unemployment is going up and you're losing jobs and so on and so forth. So while on the asset side, you want to invest and invest aggressively as it continues to go down, on the other side, which is managing your job, you need to hunker down. You need to keep your head down and preserve your job and not take aggressive, job changes and, wage demands and so on. This is not the time to do that, because the business cycle, once it turns, it stays that way for 12 to 18 months. So if the recession is happening now, most likely in February, March of 2025, most likely until December of 2026, it'll feel recessionary. What does feel recessionary mean? Feel recessionary means that it'll feel like everyone around you is losing their jobs. You may be one of them. It may feel like prices of things is actually coming down over time, not going up because demand is going down. It may feel like restaurants are empty. It may feel like nobody's buying cars. It may feel like, your gardener who you wanted to employ is all of a sudden gone because a lot of people fired him. So every person that loses their job impacts 7 people around themselves because of the people that they employ and the people, vendors and so on that they use. And it may feel that way. And S&P yet may still be going up around that time because S&P corrects way in advance of a recession and is going up while the recession is actually unfolding. And the second thing is to preserve cash and liquidity, reduce leverage. Credit card debt is a killer in times of recession. Banks will raise interest rates and come after you for minimum payments, and it's a worst kind of debt that you can have in times of recession. Preserve cash. The more cash you will have, and preserve liquidity. S&P 500 is diversified within itself. So you don't need to further diversify with the S&P 500. But single names such as Nvidia and tech and this and that, the cleaner portfolio you have, the better off your staying power will be. So 3 things I told you. 1, invest S&P 500 exclusively. 2nd, hunker down and preserve your job. Number 3, do not get any leverage anywhere in your economic system, in your ecosystem. The more leverage you have, the more your staying power will be lower in times of stress. So reduce leverage wherever you can. S&P 500 is down 15%, but there is something that is up a lot too, and that's things like fixed income. TLT has given you almost a 5% return for the year. If you remember, we talked about it at the beginning of the year that TLT will be a fantastic investment. Well, that investment is somewhat played out in the near run. It is already up 5%, and you want to book profits on that and reinvest it into something riskier. Now, if unemployment goes up, it's possible that bonds continue to do very, very well. But at the same time, a big move for the year has already occurred. You don't want to chase fixed income at a late stage, because what may happen is that there is profit taking, and 10-year yields now at 3.85% and not as attractive as they were at 4.8% just 3 months ago when we first talked about them. Now, I'm not a seller of fixed income into perpetuity. So in other words, if yields were to back up in a meaningful way, close to 4.4 or 4.5%, I would be a buyer again. But as of now, today, right here, right now, I want to again drive home the point that you want to differentiate between your portfolio management at an individual or a household level and your life management. Portfolio management can be quick and fast and nimble, but life management has to keep the next 12 to 18 months in mind, because a recession, which is almost a foregone conclusion at this point, because the damage from all these tariffs and this barter system of trade is already done. Even if the tariffs are removed, that may help assets, but that will not help the real economy. Because think of it from a big company's standpoint. A big company that is managing supply chains, they're not going to react every day in terms of the decisions they make. A company like Apple, that gets a lot of the supply chain out of China, if they disentangle their supply chain and start to get that supply chain within domestic United States and so on and so forth, they're not going to then, once the tariffs are lifted or renegotiated, immediately go back to China. So in other words, the supply chain, once they're broken and people get used and companies get used to managing it differently, they're not going to re-engage and change that supply chain very quickly. So again, managing your personal life and your circumstances in what will be a recessionary economy the next 18 months, and your portfolio, which can actually do very well in a recessionary economy, are 2 different decisions and have to be looked at differently. You would ask me, when was the last time we had a recession? Well, 2020 was a minor recession during COVID, but it didn't last very long because a vaccine was found very quickly. In the last 300 years, tariffs have been used as a tool twice in the past, in 1825 and in 1925 and 1930, pre the First World War. In both circumstances, a recession lasted several years. And in 1930, it got accentuated because a war followed right after. I'm assuming there's no war following right now. So a recession, plain vanilla recession, one should expect that will last 18 months to 24 months, something like end of 2026. It is not something that you go like this and you have a recession today and it's gone like it happened in 2020 with COVID. The last 2 major recessions in the last 50 years, one was 2001, which happened on the back of housing market collapse, and one was in 2008, which happened to the financial crisis. There is no financial crisis happening today. Banks are in great shape, bank balance sheets are in great shapes. So every recession has a different flavor to it. It's not going to look like the way it looked like in 2001 or it looked like in 2008. This is now a tariff-based recession. But even though the character of the recession may be different, the implementation of the recession ends up being very similar. Unemployment almost always goes up. Right now it's 4.2%. It probably gets to 5.5% in terms of unemployment rate. So that's a common characteristic in every recession. S&P 500 always corrects about 20% high to low. It's already corrected 15% as of today. So it's not like it's very far from where it gets to in a recession. And number three, it lasts a while and it feels horrible because everywhere you look around, it feels like people are consuming less. It feels like ultimately, what is the income of the country? Income of the country, the so-called GDP, is government spending, investments, consumption, and trade deficits. And if consumption goes down, which is a major component of government of the GDP, it obviously will lead to a recession and will lead to a lasting impact as it rise down. Hunker down, people. That's what my advice to you is. Do not worry about your portfolio. That will be fine because American economy always comes out of it, but the recession will last. So in summary, the tariff or the so-called war on trade is real. It is here. Clearly there will be negotiations. Clearly countries will talk with the United States and something will happen. But the business impact of it, the actual reality on the ground, that damage is already done. It almost doesn't matter what happens between now and the end of the year. So hence, the key messages I want to leave you with is prepare yourself for a recession that lasts 18 to 24 months. That does not mean that your portfolio will not do well and the S&P cannot go up. S&P often goes up in the middle of a recession. In fact, it always goes up. S&P loves recessions because the Federal Reserve cuts interest rates, monetary policy is easy, interest rates are declining. It is just a great environment for assets. But reality on the ground, life on the ground, it feels tough because unemployment is going up, demand is going down, consumption is going down, and it just feels tough. So hunker down, reduce leverage, and do not scare away from reinvesting your portfolio aggressively in an unlevered way in the S&P 500. That's it from Finance Dad. Don't forget to like, comment, and subscribe. That helps me grow my podcast. And don't forget to book an hour of consulting with me if you want more detail on what portfolio and what you can do better and how to reach me. You have it right at the bottom of your podcast. See you next time.